Welcome everyone. How we doing? Morning. SK Christian. How we doing? That's a different name. Is that the same person on the other side of the world or different? Ah, nice. Nice. Love to hear it. Yep, it was a fun day today. Hope everybody enjoyed it. Market's not always that friendly and easy on big old moves. Oh yeah, I'm sure. I think you've just missed me. I've been in there, on and off. Yeah, today was a rally. It was a nice one. Love to see that. And like a one that like I love a day that gives entries, gives plenty of entries. The market made it very, very obvious it was in buy mode. They're like not to say there wasn't a couple of nice shorts today, but like dips were so easy to buy all day long. Like the market really wasn't even market wasn't really even trying to hide what it was trying to do. I mean, I know some people still got caught offsides trying to be short, but um, the market made it pretty clear it was in running mode today. So, but we're gonna kind of talk about that because people were, of course, trying to short today is what it is. Thoughts on Apple tomorrow? Who knows? It's been a strong one. That was really the only thing that worried me was just kind of that rejection at the end of day. We got to see how it opens. When you zoom out and look at the big picture, I want out of this box, basically that 213.30 area, to start to look for the gap fill. But the issue that we have with the gap fill is that all of these days traded within that gap. So it's not like a normal gap where like maybe we haven't spent much time there. So this gap I don't, and I mean it could, it's been like staying green when things are clobbered. It could totally make that run, in a day if it wants to. But it's worth noting these kind of lows over here. I do know that for me, like it's not where I want to be short or anything like that. I might consider looking short up here, to 216, 217 area to maybe give it a test run on to see if it's ready to be above that gap. But for now, it's been one of the stronger tech names throughout all of this clobbering. So I think it's worth it to keep your eyes on it, but putting in nice moves. But not where I'm short personally. I'll be looking for breakout traded. I love Apple on a Friday. It's a fun one. What do Eli Lilly do? They had earnings. Oh no. Oh yeah, they already had it. Wow, what a beat, at least on EPS. I gotta go back and read it. I haven't read it. Let's see. Seems like pretty good numbers. Man, nice wow. Nice numbers, nice guidance. I mean, I haven't read it. I'm just glancing at the headlines. Nice numbers, nice guidance, nice rev guidance. We got smoked all day. That's pretty funny. Wouldn't have expected that. Wouldn't have expected a $40 drop on that kind of earnings, but it is what it is. Well, was the earning call really during the day? That seems to have leveled it out. Nice, you were in it. Yeah, that's a ripper, man. The $120 gap up is, you don't see them very often. Welcome everyone. How we doing? Hope we all had a good day. Wow. Eli Lilly crushing. We'll give it a few more minutes. I know that these we'll see how these attendance goes on these lectures for the next little bit with the mastermind ones going on. I actually just got done doing a mastermind lecture here about 45 minutes ago. So we have them kind of set up at the same time, obviously, because it's a time of night where people can get. I was hoping for a nice big attendance on this here trading psych lecture, but unfortunately, they typically don't draw the largest crowd. Ooh, yeah, I found unfortunately, I think there's a lot of people done with that. And it's hard, this market is a tricky one because, we had like, there's no denying this was a massive sell-off, $40 sell-off in 3 days. Like that's huge. So there's no denying that, but it sucks people in and people unfortunately kind of uh they want that to keep going, like everybody wants puts when the market's going up and everybody wants calls when the market's going down. And typically by the time they make the decision to switch from wanting, calls while it's going down to puts is about the time the market's going to bottom out. I'm not saying that the market has put in bottom. I do think over the next couple months, could even be next week. We could see some new lows, see even lower than we have traded. But for now, um, you know, being long has been easy, on and off for the last few days. Of course, those first, couple of days of the week, we saw those massive sell-offs, not massive, but real big sell-offs end of day. Yesterday, obviously, market got really, really clobbered, but got some nice, got some nice enough data that the market was happy. Jobless claims going down, I believe. And so really nice rally on it today. And then today was one of those days where, we saw the market sustain the move. And what do I mean by that is, we grinded up all day. We did exactly what we wanted. Pullbacks with dips to buy, grind up, some like additional pullbacks to buy, market's still telling us to be bullish. So not only pullbacks, but nice consolidation for a couple of hours for ultimately another push up and a nice strong close on the markets. We'll see what they want to do today. But today was just a completely different story than say yesterday, smoked. 2 days ago, I mean, the thing flies from 5.7, flies up $12 only to drop, 8 into close. I mean, so, that not super bullish price action. Again, big push up, give back over half the move, not super bullish price action. And then before that, obviously just selling, that was when the selling was going on. Nice sell down, sell down. So today was the first day where buyers showed up, they bought the dips, and they sustained. It was a hard one to. The other days were easy to short. We'd see some faltering without, going. Well, obviously, this one was easy enough to just stay short yesterday, but we were seeing faltering. We were seeing like consolidations, bigger pullbacks, rejections, consolidations on like reducing volume that ultimately met with selling. So there's reasons to be short. Today, though, there was not. Not to say there wasn't some nice scalps, but there really wasn't like reason to be bigger short. Okay, give me 1 second. Okay. So welcome everybody. Happy to have you here. Dirty River. Tonight we are talking trading psychology. And this isn't, we're gonna talk, and I'm gonna, we're gonna start with me asking you all questions. But we're going to talk about trading psychology. We're going to talk about some of the things that the normal things that people struggle with, whether it be bias or whatever it is, news, those kinds of things, maybe some things that they struggle with. But then I want to talk to you about it, and we're going to kind of apply it. Some of my most popular lectures lately have been the price action ones, where we kind of go through price action on the day and just discuss, what would have been reasonable entries, what would have been reasonable stop outs if we did take the trade, whatever it was, and really apply our trading psychology to the charts. And so, what do I mean by that? You know, things like holding trades down 70%, that shouldn't happen, and don't get me wrong, everybody gets blown out on a swing on occasion, where it gaps in the opposite direction, goes way against you. And there's, and there's nothing you can do about that. However, it's what you do after the fact that really matters. Do you do the responsible thing and just take the stop out? Do you let the market work for 15 or 20 minutes to see if, maybe the gap up or gap down against you isn't going to hold? But uh, ultimately, if you're in a trade, if you're in any sort of day trade, even, I mean, swing trades, you need to set stop losses. We got a couple of people in here that, as best I can tell, they're allergic to a stop loss or something. They just refuse, and they have trade after trade going minus 60, 70, 80%. And sometimes it comes back for them. Great, and then other times it doesn't, and that's what we've seen with so many of the members lately is just them holding and praying that it comes back. And in a market like we were just analyzing, on these large time frames, like you don't want to be a put holder on the day that the market rallies $10, because I'm not going to say it's fine, but when you have a ranging market or you have a market making, a couple couple dollar moves in the day, if you're wrong, you're wrong. And by the end, even if you hold all day and you make that bad decision, you can normally get out pretty all right. On a day like today, it just doesn't work. You hold your puts all day and they go to zero. That's all there is to it. When the market rallies like that, you get destroyed. Same as people yesterday, we had big buy up, sell off, and then a big gap up. So the call chasers off the open just got obliterated. And if you held all day, like I said, it's one thing if the market's in a $2-3 range, and we, maybe you get in at 531 for some insane reason, and we get down to this 529, you're going to be down 30% or whatever it might be on your trade, but that's all right. But when the market moves like this, I mean, your contracts are at zero up here, and then you have to just continue to watch the market move another $6 against you, you know? And so those are the kinds of things that we want to talk about today and how we're going to try to apply it to charts. Look at the charts, ignore trade floor, ignore the crazies in VC, ignore the people on Twitter, and just look at the chart and say, what's the chart telling me? You know, should I be in this trade? Should I get out? But so before that, I want you all to tell me some stuff that you deal with. You know, what are some trading psychology issues that you have? I'm sure that issues you have are the exact same issues other people have. I, of course, have a big old list of them. I'm sure that every single thing people bring up or things that people talk about are going to be, you know, already on the list, whether it's, you know, bias, trying to trade around news and not understanding the news. Like I said, people on Twitter, people on trade floor, you know, taking a bad trade and just not admitting you're wrong, adding to losers, not moving stops to profit. I'm just reading through my list right here. To, you know, just give some examples, you know, and okay, yeah, here we are, not taking profit. That's moving stops to profit, you know. And then, yeah, can't take profits, not wanting to stop out. Yeah, I get it. I got that on my list. I have it listed as don't like clicking the sell button. And it's true, you know, people have that issue, you know, there's something about it's one of the really interesting things I saw. And, you know, this lecture is just going to be chatting more than anything else for at least the, you know, next 25 minutes or so. So type away in the chat and, you know, respond to things I'm saying. And let's talk about some things because that's one of the biggest issues that I see. You know, somebody will hold a trade for a 60% loss and then they see that thing like 3% green and hop out, you know? And I mean, don't get me wrong. I think that like that's kind of the right choice, you know, if you get saved on a bad trade and like I don't care who you are. If your trade goes more than 50% against you and it's not due to a gap overnight or a gap, you know, anything like that, that was a horrible trade. You had horrible trade management. I'll tell that to anybody, anytime, you know. So I do understand when you're down bad, you want to just jump out of the trade, but it's when you do it over and over, you know, if you're always finding yourself in those bad trades that go 60% against you, stop doing what you're doing because it doesn't work, you know. Like we've seen it in here, the people who hold the bad trades forever, then they celebrate that their full port came back and made 20%. Well, they typically disappear because that type of trading you just can't last in the market, you know. Oh yeah, when you have a red day, you want to make the money back, so then you trade more, and then let me guess, you likely lose more money. Oh yeah, panic selling. That's a good one. There's definitely some panic selling on longs going on today. I saw it on trade floor a lot. Oh yeah, recovering mentally from a red day. I like that one. I'm actually gonna add that to the list because everybody has them. And I hear people struggle with that a lot. They're like, you know, oh God, like when I have a red day, it just cascades and I have, you know, 3, 4, 5 red days in a row, even after I've been doing really good. And the best advice that I can give on something like that is just ignore it. Like everybody, every single trader you know, if they are a real trader, they have red days. Like it's impossible to not have red days sometimes, especially for people that aren't doing it full time. You know, as a full time trader, you have the ability to, you know, you're trading all day, you're watching the market, you're going to take some losses, you're going to take some wins, but you just need to come ahead is all you need to do. But for people who can't do it full time, those red days are unfortunately just going to be more common. And the worst thing you can do is start trading. You know, like if you wake up the next morning and you're still grumpy from your red day the day before, don't take a trade. And if you are going to take a trade, watch the market for like a couple hours because chances are you're going to make a real horrible decision. Ooh, yeah, chasing the losses, you know, that's a hard one. That's a hard one. And, you know, and everybody does it. When people see red, they're like, okay, well, I'm just going to take this trade to try to make it back. Or, you know, oh, I'll just go a little bit heavier and I'll try to make a little bit more on a smaller move, and then they just lose more. That tends to be how it goes. And so, yeah, oh, I'm seeing constant red days, and that is just so hard for the emotional side of things because it sucks when the port's going down into the right, I get it. Like it's really, really hard. It can be really, really mentally draining. I got a good buddy that I work with, and he's dealing with that. He's on the right path. We've got him on the up and up. But man, those still those red days just smoke him, and he tries, he'll just get so in his head about it. And the best thing you can do is move on because what I try to tell people is, trading, it's a slow thing. It's not fast, if you have a red day, who cares? Hopefully your next day is green. And then, try to get a few green days under your belt. That's it. And then maybe try to get a whole green week under your belt. And then maybe a couple weeks and then a month. And then you'll realize over time, those red days, they come and they don't matter much, because in the big scheme of things, as long as you're just more green days than red days, then you're going to be happy in the end, and like that one red day, it doesn't matter in a month. It doesn't matter in 2 months, if you are really having a bunch of red like weeks and months in a row, that's obviously going to keep on wearing on you. And the only thing you can do is just slow it down, learn some things, plan some trades, really, really follow your rules. If you have like issues with things, chasing entries or whatever it may be, make it a rule for yourself that if you can't get in at the exact price you plan on getting in, even if it's $1 off, you don't take the trade and just limit yourself that way. Give yourself rules. And so great. I see all of these, I see all of these all the time. Again, people selling early, all of that kind of stuff. All of that always just comes back to planning. We should talk about that a little bit. People always try to talk about, oh, I sold early. I should have held longer. But the people who, don't sell early and hold longer, most of them end up losing money, because sure, I'm sure people got some spy calls right here and then they paid and they paid and they paid and people were like, then they sold, oh, it's just a bounce. And then it goes more and more. And then they're like, oh yeah, the breakout's coming. And then 3 candles later, they're red on the trade. But the smart people that planned to trade, played to pull back to the trend or whatever it may be, they took their little scalp on it, re-shorted, So you have to remember, for every one time you think you should have held longer, there's probably 10 times that if you held longer, you ended up losing more money. The market's been putting in big trends for us lately, but the reversals have been absolutely vicious. It was even yesterday, I saw this candle. I hit some calls down here, knowing that my stop, was a buck or, 80 cents or whatever below me. So I gave it a little test run. We were also working on a nice little 3 push wedge. I just trade the chart, like, yeah, I'm buying calls on a $12 down day or whatever it was, but this made sense to me. And I saw somebody that I had seen posting a trade for about how much money they were making on their puts all day. I saw somebody on this candle say, I couldn't move my stop fast enough. Just gave back all my profits. So the market can be like that, And so you don't ever want to be the person that holds so long they end up losing money. That is no good. I see that a lot more selective on what trades to take. That's one of the best things you can do. Okay, that's I sit and I wait for my ideal entry and then I take it. That's all you can do as a trader, And so that's going to lead me into one of the first things that I'm going to bring up, is bias. And bias has always been an issue for traders, but I couldn't, I was unable to comprehend the level of bias that traders have until I joined OOT. We have people in here, that shorted this whole run. And they're proud when they catch their little pullback. Or even if we zoom out even farther, there's been people that have been shorting SPY for this whole run, trying to, oh, it's a Ponzi scheme, blah, 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 or the fake market, oh, this doesn't matter, we're gonna collapse. And look at the chart, So that's one of my biggest things, and how we're gonna start, applying this a little bit to some trading psych stuff is you got to get rid of your bias. And that goes hand in hand with where you're getting your information from. You can hate the market all you want. You can think that it's all a scheme. You can think whatever you want. But if the chart is going up and to the right, you better be trading it up and to the right. And so one of the, one of the main things that I see, because I work with a ton of people, in OT, I get DMs all the time. I get questions in trade floor. I talk to people all the time about this. And so one of the biggest issues I see from people is bias, like there were people on trade floor, a bunch of them, trying to short this move all day long. And there was people trying to long this move all day long, no matter what people tell them, no matter what you do. And I've realized a lot of the time it's because they don't understand the news, as weird as that is, that's going on with the market. Whether it's CPI, whether it's PPI, any of those things, in any sort of inflation data, any sort of employment data has been absolutely crucial. And so they're typically the loudest people in the room, and they typically know the least. And that's a common theme that you will see in life. And so we have these people that have an extreme bias. Generally speaking, it's the bears that have an extreme bias, and they're trying to back up their bias with the news. And so what I always try to ask people, when I do get the DMs of people having a rough time and they're trying to tell me about, well, this data is bad because, I ask them, do you actually understand the news? And I'm going to tell you right now, it's fine if you don't. Economic stuff is super boring if you aren't into it. There's no way around it. And so if you aren't into it, that's fine. But you need to go to trade floor and ask people that know a little bit more about it. People like your Tilios, your Revs, your Me's, the people that are into economic stuff. And ask them their opinions on it. And me and Tilio both, if you would have asked us yesterday, if you would have asked us yesterday, what do we think of the jobs numbers, of the data coming out this morning? What do we think of it? Both of us would have had virtually the exact same answer. We would have told you, well, at this point in the market, we are for the first time in 2 years seeing bad news be bad news and good news be good news. And so my answer, and I don't want to speak for Tilio, but I'm 90% sure that Tilio's answer would have been, if jobless claims come down, the market's going to rally, because that is now good news for the market. So don't have your opinion, yes, we wanted jobless claims going up a few months ago. So it was reversed, and people couldn't grasp, unemployment going up being good. And we finally saw, last week, unemployment went up when they don't want it to anymore, and it was bad. So we're finally seeing that. So don't let your bias get in the way. Don't let your opinions get in the way. Ask somebody who knows better than you. I do it all the time. If I don't know an answer to something, I ask Tilio, because he's a person that I can ask, I can trust his opinion. And so I go for it. And so be very, very careful with a bias, basically don't have a bias while trading. And then be very, very careful where you get your information from. Trade floor, they're always wrong. Twitter is like 98% of the time wrong. And if you watch any of the biased news stations, I don't care, left or right, they're both kind of questionable. Like if you're watching CNBC, market's going down, they're going to have bears on the show talking about the end is near. If the market's going up, they're going to have bulls on the show. So always ignore those talking heads and go and find yourself somebody with some, bearish, or, somebody with like a lack of bearishness or a lack of bullishness that's just the middle of the road, and they're generally going to give you the best answers. They're always going to be better than Twitter or Trade Floor or anything like that. That much is for sure. Oh yeah, the bond. Yeah, the bonds were an interesting one. The bonds yesterday were actually an interesting one, and they came out somewhere around here and ultimately gave us a bunch of this breakdown, at least in my opinion. And it was, that's another economic thing. Super advanced, super boring. Nobody knows about the bond market or how it works or what it does. I only know some things because I was interested in it and I read it. And so we had a bond auction yesterday that was weak, but it had much more demand than people expected. And what does that mean? That means that some people have some there, the recession hard landing fear is still out there. And so you put money into bonds because it's safe that way. And so what I had said was the bond market's not going to, the bond auction is going to do, and this was yesterday, the bond auction is going to do nothing unless there's like zero demand or more demand than people expect. If it just kind of winds up right where people want it, I think we would have had little to no reaction on that move. And it was released, oh yeah, 10 o'clock. So like, right around here, 10 o'clock my time. And you can see that selling was pretty, we had been bouncing and all of a sudden we just continued to get clobbered after that. Not saying it was the entire reason, but it was one of those weird ones where it was a weak auction that was stronger than expected, had, relatively low demand based on the tail. That's what it's called. None of that matters. And so we sold pretty heavy on it. And then today, auction, we had a 30-year auction for anybody who doesn't know, you might have not known, happened, I don't know, right here. Likely gave us a little bit of juice on this boost because it was a little weaker than people expected. So it likely played a small role in this little bounce, that ultimately got us moving again. So some nice support bounces. This candle even pulled down perfectly for it right after the auction and then went. And so know your news, know your sources. And then so once we've done that, once we've kind of identified, our bias and these things being scared to be read, not stopping out, now we got to take it to the chart and we got to work on our bias and we have to work on our trading and things that, what are some things we can do? And the main thing that I tell people to do when you're doing any sort of trading is get yourself as many things on your chart as you can to the point that you don't feel stressed. You want to, what I tell everybody, it doesn't matter what trade you're in. You just want so many things in your favor before you enter and you want so many things in your favor before you enter the trade that the risk, the reward, all of that. And so use those things like support and resistance, use those things like trend lines, EMAs, whatever it may be. If you like the opening range like I do, use the opening range and follow your plan. Quit getting tied up on, oh, I sold too early or things like that, because who cares if you sold too early if you followed the plan? Like if you're buying SPY calls right here and your plan is to sell at this level, you sell at that level and you look for a re-entry. That is what a smart, non-stressed out, high success rate trader does. And you have those reasonable price targets, And I mean, you could go back and find this in Trade4, and it's funny because I made a kind of a smart ass comment to my buddy when he asked me it. And so we're trading down here at 527. I think it was earlier in the day somewhere. We're one of these 527s down here. And he says, are we going to 531 today? And my only response to it was, I don't do those stupid price targets like you degens. That was my comment. Have safe, smart entries, profit targets, and stop outs, and you will remove like all of the stress from your trading. And when you remove the stress from your trading, you'll quit having FOMO. You'll quit chasing trades. You'll quit tilting and just adding and adding and adding to losers. That's a huge thing that we see. It's the main way that we see people blow ports. Well, right behind SPX is people that average down a lot. Those are the two things that blow more ports than anything else in OOT. And so what do I mean by averaging down? Well, maybe you enter calls here and then you say to yourself, hey, I'm going to add some more. If you are making that decision, you need to have that in your plan before you enter the trade. Maybe you're buying calls here because you're expecting the breakout. I think it's not a good idea, but maybe you're doing it. And before you buy these calls, you need to say to yourself, if we pull down here, this is where I will add. And it needs to be in your plan before you take the trade. And if that is your plan, half position, and then you get in full position down here. That's how you do it. If it's not in your plan before, you do not average down. And there's a really famous trader out there. He has a quote that I love, Tudor, if anybody wants to look him up. He's old, famous guy, one of the greatest traders of all time. And he hung it on his wall. And it says, losers add to losers. And there is a very fine line between averaging down a trade and adding more money into a losing trade. 95% of the time, you're better stopping out of the trade once it goes against you. And so that to me is one of the biggest trading psychology things that I think everybody needs to work on. It's one of the biggest issues I see in OOT is that it's just people that don't want to stop out. Like they can't click that sell button when they're red. Like, and they feel perfectly like, they just, they can't, like, they feel fine. They don't care when they see these positions down 70 or 80% red. And then as soon as they go green, even on a good trade that doesn't go deep red, they panic and they sell the whole position and they don't follow the plan. And why is that an issue? Is because of the reality of what those trades mean, because you can't shake your bias, because you can't admit you're wrong. You guys have all heard me say a million times, admit you're wrong and take the stop. We all do it, And so I don't know why people can't. And I think part of it is because they just don't understand the reality of what it takes for those positions to come back. So just a simple example that I always use, and it always it can be eye-opening for people of you have to think of it this way. If you buy a contract for $100 and it goes down 50%, you now need the contract to increase 100% in value just to be break even. So if you think about it, if you buy it at 100 and it drops to 50, well, those people who buy it at 50 are going to be selling at 60, are going to be selling at 70, are going to be selling at 80, are going to be selling at 90. You're still break even or not even break even while they're selling for profit. So it's just not realistic. And once you pass that 50% mark, it starts to really, really, get worse and worse. If you have a trade that's down 90%, that means that it had to run somewhere in that 300 to 400% just to be break even. And so sit and ask yourselves, would you ever take a plan or a trade with the plan of it needing to run 300 or 400% to make money? No, because that's a really, really bad trade, a really, really bad plan. So always take the stop out. We as traders, our biggest issue, our biggest enemy with all of it is unfortunately ourselves. And because we get in the way of ourselves trading, we're the ones who don't click stop outs. We're the ones who don't take profits where we say we're going to. And so that's what I always try to do is I always try to encourage people to really trade your plans, ignore those people on trade floors just giving you random price targets, ignore the people who you've never seen a chart from you've never talked trading with them, you just see them trolling on trade floor and saying full port puts or full port calls, whatever it may be, and just uh you know trade that's short. And so how do we do that? And so this is the part of the lecture where we're just going to go back through a couple of days. And we're going to skip this day because that one was a little bit excessive, but we're just going to look at these charts and I decided I'm just going to run the 5 and 13 EMA. It's a really nice combo, a bit more volatile than something like the 9 and the 20, but it can show you some nicer moves. Pullbacks to like that 13 can work really good. And we're just going to kind of go through the charts. Obviously, like I always try to profess during these types of things, this is hindsight trading. So we don't, we get a look like we would do perfect. But would we actually do perfect in this situation if it was presented? Well, maybe not, but we have to try and see. And so I'm going to show to you where places we stop out. You hear me and Flip say it all the time, trade your levels, enter at the levels you plan at entering, sell at the levels you plan at selling, and just go with it, And so I wanted to put 520 on here. Just go with it. Just trade the plan. And then so while we're doing this, we're going to talk about, ignoring our bias, taking our trades, taking our profit when it's coming, showing where we're going to stop out when we're wrong, and then just trading the chart. And so I can already see that this is going to be a great day for it, and so we're just going to talk about it and, ignoring all of the nonsense, ignoring the stuff that everybody else says, we just want to trade the chart and trade our levels. And so obviously, what I always try to tell people as far as trading psychology stuff is always look at some of the pre-market, always look at the charts, see where we are in relation to things on the left. When we know kind of right off the open, we have some resistance over here, we have some pre-market resistance. We don't want to be diving in on these calls this early, but we want to look left and see what are some levels we care about for breakouts, breakdowns, all of that stuff. So obviously coming into the day, all of you know that I really like trend lines, so I trade trend lines. First thing that I'm going to be looking for is a break of this trend. We're opening out in front of it, but we're kind of selling down. Could you have risked the double bottom here? Absolutely. But the unfortunate issue with that is you're looking for, basically this bottom up here, $1 of movement at most. Well, if we break this low, your realistic stop is like $2 below you. So horrible risk reward, not a trade worth taking. Now we look for this next candle to break out and give us some sort of pullback because we like the entry around our 520 level, big round whole number, top of all of this consolidation. If we get a nice little pullback and push up, I'm going to be buying calls here sometime, in that first minute or so of this candle. And then what am I going to do? I'm going to be out of the position at my level. That's how I trade, And so be a nice $2 move. This is a big move, obviously. I'm going to trim on the way up as well, because always looking left, ignoring our bias. We had huge selling going on in the market before this. So I'm sure people are going in this day super bearish. Well, we got to ignore the bearish bias. If we were bearish off the open, who cares? We've now broken out, caught a trade. And why are we all out here? Because we're looking left and we know we are coming into resistance. Ignore the bias, ignore the people that are telling you, oh, ripper of a day, we're going to fly, whatever it is, And do you miss some profit? For sure. But then for the people who don't sell, they get chopped and chopped and chopped and chopped. And then we're just waiting for an entry. And so at this point, we're basically above the levels we care about. So we're going to zoom in a little bit. We're just waiting for an entry. And we want a non-consolidation entry. And we want to enter low. So we can see we're kind of riding this 5 EMA. Here's the 13 EMA. Very, very cut and dry. We enter here, stops below. That's it. Very tight. We take the stop when it comes, no questions asked. Ignore the buys. We're probably still bearish. Trade floor is probably about to say, we're going to go to 510 or whatever crazy thing they're saying. And you look for a scalp to highs. That's it. And then maybe you catch this nice pop because you see you get the push up to highs. You've trimmed your contracts because you caught a dollar move. And then you can trail your stop up. So this is another thing I wanted to talk about because we saw it in here. One of the main things people say, I sold too early. Well, if your plan is sell at this level and you sell at this level, you sold at the exact right time. But what are some things we can do on the chart? It's something that I always recommended people to do on the chart of how do we take trades and how do we trail trades? My favorite way to do it is obviously you're going to trim. And so my rule of thumb is if I trim a contract, I move up my stop. And where do I move my stop to? Generally, the low of the previous breakout candle. So we took a night, we entered low, entered on our EMA, entered at our support, nice tight stop, pushes up. We get our trim off right here. I move my stop here. It's likely going to be just above break even. We get another push up and we let this next candle form. We still break out, move my stop up. We get this nice big old breakout. I'm here. If I'm not fully out at this level, then I'm getting stopped out when it pulls back here. Now, for me, I'm still watching. I'm still in bull mode. Market is buying. So for me, I'm really looking for a test of this EMA right here to look to get long again, knowing my stop is a close under this level. And you can see 2 candles later, I'm stopped out because that's what it says. My bias was wrong. I thought we were going to bounce. We didn't bounce. I had EMAs. I had support. I even had increasing volume in my favor, so reasonable enough entry. And I get stopped out. No big deal. We've hit 2 nice trades already. And now we've stopped out of one that ultimately ended up being a 15 cent, 20-cent risk. So no big deal. Now we pull down again. You can potentially buy this, but when I have just stopped out, this is where trading psychology comes into play. When I just stopped out, I'm absolutely no chance, no way buying a contract on the next candle. That goes right into your FOMO. That goes right into your chasing. That goes right into all of that. And then as we can see, ultimately, put chasers get smoked, as all chasers tend to do. The people chasing the downward move obliterated on the next one. So I got stopped out, and you can see a few candles later, it goes to profit. I don't care. That means nothing to me, who cares? I took the stop out. So that trade is over and done with. I move on. It makes nothing to me, or it means nothing to me. So again, just watching it, ignoring the bias. Obviously, we're still buying, buyers still showing up, volume increasing. Now we're really just looking for another entry. This one pushes way too far from where I would like. I would buy a pullback to 524.30 again. Same reason I entered here. I would buy this pullback, but I don't get it. So I have to wait. And I wait and I wait. And there's no sort of seller volume or anything to tell me potentially short this as a double top. So I wait for a break above and I buy the very first pullback. You can even wait if you want to wait till this EMA that I told you is great. You enter here, or you enter here, and you exit on a candle close below that. So you're risking 40 cents of downside, and then you get chopped around for 25 minutes, which you don't like. Ultimately, you catch that nice pop up. We're going into midday, so you can kind of assume these won't get running. But what I would do on a trade like this is catch that pop up, trim off most of my contracts once we start to go sideways here. And then if I have a runner, I'm just going to bump the stop above entry. And with theta, things like that, this chop can ultimately stop you out, but it's still going to stop you out in profit. And then, now at this point, you basically have to be watching 530. Doesn't matter. We're coming up to 530, big whole round number. You always want to be cautious there. So for me, I'm not buying this. I'm not buying the break of this level because 530 is right there. You can get absolutely clobbered, and so I don't take that trade. I'm sure you can short 530 speculatively, but the issue with it is if we pop, we're going to absolutely fly under it or over it, So you don't want to be the first one in the short trade. So you let the short trade play out. Again, bunch of FOMOers chasing this and then getting blown out, but not us because we don't FOMO. We don't chase trades. We try to, read the chart, use our trading psychology there. This is to me about the only reasonable short entry that you have from all the way over here, all the way through to down here. There was nothing for me to do. And while this is closing over the 9 or 5 EMA, 13 EMA, because it crossed up here, that's what I'm looking at. We have the EMA crossing. We have our first bounce on reducing volume from the sell-off. And then we have big solid green candle. I short this thing with basically a stop over 528. It's going to be right around, 50% or 50 cents, something like that. We had this resistance over here previously. So we know if we get over that, we get stopped out, 50-cent risk. And then for me, I'm looking ultimately down to 526. So you got $1.50 a downside all planned out for you. Obviously trim. And then you guys know me, I'm fully out of the trade right there. But if you're a holder, we get a breakout candle, you move your stop. We get another breakdown candle, you move your stop. We get another breakdown candle, you move your stop, and market closes and you print it on the short with the safe non-chasing entry. Because this is an interesting thing I want to talk about. Everybody loves patterns and they all try to trade patterns. And they don't understand them. Because this right here, when this day was going on, people were calling this a bear flag. And so I want to talk about flags. What is a flag? It is a push up or push down, depending bull or bear, push up or push down, and then followed by consolidation with a continued move in the direction it's been going. So the market is in an uptrend right here. No questions asked. The market is in an uptrend. What that means is a bear flag does not exist. A bear flag only exists in a downtrend. And the market, you have to look big picture on the market. The market has been selling for 2 candles. It has been buying for 50 candles, something like that, you know? So yeah, we have two down candles. But if you, I always recommend change the time frame and do you see the same thing? And when you come back to these things, I'm not calling that a bear flag. I'm calling that a sell down to support, you know? Even if you go to the 30-minute, you'll start to see you can get too far out. But look at this. This is like bullish. And then we get a C when we zoom into that back into that shorter time frame. Ultimately, anybody who thought that this was a bear flag that was trying to trade SPY or SPX into close, and they did, they got absolutely obliterated. You know, you had a $2 rip straight in your face. And you buy up to this resistance, you buy up to this EMA, that is where you short it because that gives you the most confirmation, not a maybe potential bear flag that are really just inside candles after like the biggest sell of the day, you know? That does not make bear flag. This is as crazy as it sounds. Here's your pull. Here's your flag. I know it's ugly. Here's your flag. Technically speaking, this is a bear flag or a bull flag, not a bear flag. Pull goes up, flag comes down, you got yourself a bull flag. You know, that's how it works. So ditch the bias. That's one of the reasons I hate, you know, named patterns. You know, that's a bull flag that ultimately failed, gave you a really nice attempted breakout, ultimately failed. But bias is so bad when you start to use a named pattern. It's like a head and shoulders. You know, head and shoulders one have a very low success rate as you know most traders see over time, and part of that is because head and shoulders don't exist without a double bottom, and a double bottom has an extremely high success rate. And so you have low success rate head and shoulders, you have high success rate double bottom, which is literally a crucial part of a head and shoulders. And suddenly you start to realize maybe those head and shoulders trades don't work quite as well as you think. And then let's see. So really, the last things that I wanted to cover is, and I'm really happy this one did it, is, and we already touched on it earlier because so many people talked about it, is just stopping out. And how do you get past the hurdle of doing it? And the best way that I can recommend for anybody to really get past, you know, stopping out is trading your plan better and making your plan better. So we're going to go back to this trade that, and I think I actually took this if I remember right and got stopped out. So we're going to go back to this trade right here that I stopped out on. So, you know, we can't see what's happened to the right of the market. We have no idea what's going to happen. We've basically seen about, you know, well, we've seen this much, and we've seen strong uptrend in the market. You know, a couple entries. We had an entry down here. We had another entry here. So we're looking to catch that same trade when we're seeing something like this. We are technically setting our first like sort of kind of higher or lower high, which can be a sign of reversal of trend. So we're cautious of that, but that's why we aren't buying calls up here. We are buying calls on the touch of this level because, you know, the break of the level worked, rejections of the level worked, you know, the buying down here up to this level worked. So we want to assume that this level is going to work. Well, I know this is where I want to get in way back here. When this candle breaks out, I say I am looking for a retest of this level to buy some calls. So all of this stuff happens, you know, I don't chase it. I just watch it. All of this stuff happens. And then I finally start to see you know, I finally start to see the pullback coming. And so here's my plan. I'm entering here. I'm saying to myself, I'm stopping on, you know, I'm basically going to set a hard stop about 524. You know, that's where my hard stop, that is the most that I'm willing to risk on this trade because we might just, you know, wick below it. You know, I might even bump it down to, you know, 523.90. So I'm going to be risking 40 cents of downside. I am ultimately looking for about $1.60 of upside, one risk for reward, you know, really great trade. It's worth it, you know. But this, I always teach, have two stops. This one down here, it's a hard stop. You set it there. And why do you do that? Because then you can't mess with it and you can't hold trades that get done bad. So if you're buying a same day SPY contract right here, it's probably like $100 and it probably has 40 delta. And if you're risking 25, 30 cents of downside, you're risking $10. You're, because that's, you can calculate that from your delta. If you're losing 25 cents, you're losing a quarter of one delta, amount. And if your delta is $40, you're losing 25 cents on the stock, you're losing $10 on your delta. And so and that is your hard stop. That's the most that you're willing to lose. And everybody's number will be slightly different, but it should be tight. The better the entry, the tighter the stop. And so then that's your worst case scenario stop. Your best case scenario stop is a close under 524.36 and this EMA. So you let the market work. Well, the next candle did sell, down here below it. I mean, oh God, look at that. It would have missed you by about 2 cents. So the market did sell down here below it. Maybe you get stopped out. No big deal. You knew the risk on the trade, but we didn't get a candle close down there. Then you watch again. Next candle comes. It's sold below it. If you have your hard stop set, you likely got stopped out at right around the exact point where if you waited for the candle close, you would have got stopped out anyway. So it doesn't matter. If this one didn't stop you, if this one didn't stop you out, then this one stopped you out either on the candle close or the wick down. And the risk all ended up being right around the same, still small risk looking for that upside move. So that is what I always recommend to people. And the worst case scenario stop, I call it a protective stop. And then the other stop, I call it your presumed stop. It's where if you stop out, you're going to stop on a candle close under here. No big deal. You know that. The protective stop is so that you don't start tilting. You don't all of a sudden, oh, I went and got water and I was down 50%. Never leave yourself in that situation. One, it was probably a pretty bad trade if that happens. But two, just don't ever leave yourself in the situation. Protective stop. And then ultimately, you're happy. People might have seen this bounce. They might have thought the bounce was still coming. But in the end, you're happy because a $2 move against you, you're down 70%. Then, of course, the people who hold it, we know because we looked at the chart already, they're going to eventually celebrate that they made money. But we stopped out here. We now have an opportunity to enter here. We now have an opportunity to enter around here if we want either of those entries at a lower price than we originally paid. And so we will make more money. If you buy a contract here, it gets this smoked, you aren't going to be break even until you're well above your entry price. So that's why we stop out. And we don't, pray that the market saves us because sometimes it will and sometimes it won't, even if we go back later in the day for any of these people that were buying this dip, or they see this push, buy this dip, smoked, but you have to have your plan to stop out. That's the number one trading psychology thing people can't do is click sell when they're red. And sometimes you just have to do it. Oh man, we got Norvin in here. 470 on SPY. I think you might be mistaken. We're a long ways away from 470. And we're a long ways away from 572. Yep, Dalai Lama, don't trade out of desperation because when you're trading to try to make back a loss or, your yesterday was red, so you size a little bit bigger today to try to make it back, you are guaranteed just going to lose more. I help people with that all the time in the DMs of like, sometimes I just have to full on tell people, stop trading. Like right now, shut it down. What you're doing is not working. Sometimes they listen, sometimes they don't. But sometimes the best thing you can do is just say, okay, I am not doing this anymore. Okay, well, that's all I got on my list for trading psychology. So we covered a lot, talked about a lot of things. I know that a lot of it is just, going to be me telling you to don't do that, but is there any questions, any concerns, any other things you struggle with, just an opinion you'd like on something? I'm happy to answer. We had a nice small crowd today, so we got plenty of time to answer questions. We got 5 more minutes. Of course, you guys got no questions, we can always call it a couple of minutes early or, check out some charts or anything, but just let me know. But if you got to get out of here, as always, thank you for being here and we will catch you tomorrow. Oh, of course, Norvin's got a chart to look at. Of course, it's a chip that's already run hundreds of percent he wants to buy. Didn't yeah, right on Christina. I mean, that's like, I mean, it's pretty cut and dry right here. Like if you want, that's the level to watch. Here's the trend to watch. If I was looking for it, I would be looking for tight stops below about 144, and but ultimately looking for a push up to the trend or 150. But as it stands right now, it doesn't look good at all. I mean, we just have an inside candle on a gigantic red day, so not much info to be had here. But that 144 is a nice level, or 145 ish. If we break it, could even offer a nice short down there to about 140 zone. 143, then 140. Love it. Jay, thank you, thank you. Nah, not to me. I don't know. I mean, like, this is not really like it's not super patterny. Like, you could almost make an, no, I mean, yes, I see what you're saying. We have two close tops, but for, and this isn't always right. Sometimes it is just two candles for like a double top, or we're gonna do triple top because I spotted it. I like more like this, where like you tried, you pulled back, you tried, and then this short I would take, where we sold off it, and a few days later we're back up there. That's a short I would take. And then again, third push up here, I'm trying that for sure. So this or this would be the entry. Is there times where it is just, two candles? For sure. But the type of volatility we've had. I mean, I was talking about it with somebody. SPY has moved close to $100 this week. That is insane. So the amount of activity we have on these candles is just like, it's not where I would go looking for a double top myself. I mean, I'll of course take note of that level and understand it's likely going to be resistance, but we'll see. Oh, you're talking on the 15-minute, like this one? Like you're scalping futures and you're trying to short a double top. I mean, yeah, but this 15 minutes after hours doesn't really matter to us. This one was a bit of a lower high double top. But if you're looking at this double top all the way over to here, I still would just think of that on the daily time frame and I wouldn't think about it. You freeze when it's time to pull the trigger and the trade is gone and just look at it go my way. So that is a really hard part of trading. And what I try to tell everybody is, as traders, all we can do is swing the bat. If we know the entry, we know the stop out, and we know the take profit, and we are happy with the risk reward on the trade, swing the bat. Worst, like, as long as your trade is planned enough that you know where your stop out is, you know how many dollars you're risking, it can go that way. And so just do it, like just swing the bat. That's all you can do. And you'll get it. And if you ever have a question on a trade, well, first, one more thing. If you planned your trade and then missed your entry all in that short of a time frame, there's like a 99% chance you didn't plan it good enough. Because we'll just kind of go back to mine, the one that we talked about from back here. We wanted to buy, oh yeah, I gotta go 5 minutes. On, let's see, was it even this day? So here, I mean, this is a good example. We want to buy the pullback to this level. We broke way above it on this candle. So now we look for the pullbacks. We knew to be looking for this pullback for 10 minutes just based on these candles. Even if you don't buy that one and you miss it, maybe you didn't plan it in time. But you still want to buy this pullback. You still want to buy the pullback here. And so at this point, you've had 25, 30 minutes to say, I'm buying the pullback. So then everything can be planned. And so when you take enough time to really plan the trade, and man, I'm risking 20 bucks or I'm making 40 bucks. That's all there is, then you got to go for it, and you'll get it. And then, of course, if you ever want to take a trade or anything and you just aren't sure and you got a good plan, send it to me in the DM. I will always look at a chart, and if I'm around, I will always happily respond and say, hammer that. I mean, if I like it, I'll hit it with you. HWM. Oh yeah, this funny. Yeah. Yeah. You just love the ones that have already pumped, Norman. Yeah, you just love the ones that have already pumped. I mean, I have no interest in trading this thing. Maybe if we pull back to 85, you could like risk it at this previous all-time high. But I don't have a lot of interest in trading this thing. You know, if it was a speculative bet way back here, sure, but I mean, I'm not gonna buy something that is up 55% in the past 2 months, you know. I mean, I'm not gonna go chasing that thing. Yeah, exactly. I knew it was gonna be like the same try. Oh, but this is Sprouts Farmer Market. I actually know what that is. This one I probably hate less, but it's sort of the same situation of like, I mean, it is such a chase at this point, you know? There's not, I mean, I'm not chasing this type of candle on like earnings and stuff, you know. That's not me, you know. I don't want to be short this thing for that gap fill. I don't know how their earnings went or anything, but I'd feel more comfortable doing that. Yeah, you got it. Okay, well, that's gonna do it. Thank you so much, everybody. I really appreciate you being here. Trading psychology. I know it's not everybody's favorite topic, but it's something that I'm happy at least some of you will show up, learn about, talk about. All of that was really fun. Yeah, thank you guys so much. Yep, thank you all so much, and we will catch you all tomorrow. Trade safe Friday. Have a good one.